All right, why don't we go ahead and get started? So thank you guys very much for joining. My name is Mark LaMonica. Look after the individual investor team from Morningstar here in Australia. And today we are going to talk about risk, which hopefully is exciting. But before we do that, a couple housekeeping items. So number one, anything you hear today is general advice. I don't know anything about you, so I cannot offer personal advice. If you're over in New Zealand, you can go get our FAP from our website, so morningstar.com.au. And the New Zealand regulatory authorities would like you to contact a financial advisor if you would like personal advice. Okay, and even though I can't offer personal advice, I would obviously love any questions that you guys have. So send those through at any time, and we'll get into them. Okay, so we're going to talk about risk today, and I want to take a little bit of a different approach than what we've done before in terms of risk. And the idea is to think about, or hopefully the idea of today's session is to think about how the financial services industry traditionally defines risk. And is that a risk that actually applies to you? And when does it apply to you, and what you can do about it? So that's the goal for today. So we'll see what happens. The one other thing is, so we've decided to try one of these at night. So if anyone's interested, we're going to do a session on Thursday night at 6 p.m. Sydney time. So feel free to dial into that. Figure there's nothing to do. Yeah, why not do another webinar? So we'll just try one this week and one next week on Thursday evening. All right, so let's get started. Let me find the PowerPoint. Okay, there we go. We're going to talk about risks faced by investors. Oh, going really quickly. Okay, so let's talk about how the investment industry traditionally measures risk. And there's a reason that the industry measures risk in this way. I think the question for all of us is, as investors, does this risk definition work for us? Does this apply to us, and when does it apply to us? All right, so basically, the way that the investment industry measures risk is volatility. So if you are, of course, a portfolio manager, you're running a fund or an ETF or anything else, you're going to think about risk purely in terms of volatility. So what is volatility? It is literally just the way that your portfolio or a fund or an ETF or an individual share or bond or anything else bounces around in price. So that's all volatility is. So price fluctuations. And the reason the industry measures risk this way makes a lot of sense, because they don't know who you are, what your goals are. If I run a managed fund, I have no idea. I have no idea what you're trying to accomplish. I don't know how old you are. So how am I going to measure risk? I'm going to measure risk of course, the portfolio bouncing around. So there are a couple different risk measures. We'll go through them. A couple different risk measures that you'll hear about and you'll see if you're looking up risk on a fund or ETF. So we'll start with the standard deviation. So basically, the standard deviation looks at how much a portfolio fluctuates in terms of, in relation to its average return, its mean return. So we'll get into a little more detail on how to do this. But at the end of the day, something without a standard deviation or a standard deviation of 0 would be a portfolio that averages, let's say, 5% a year, but every single year it hits 5%. Right? So we always hear about, and this is something that is important to remember, we always hear about portfolio returns as average, and that makes sense. But what that doesn't tell you about is what's the dispersion around the average. And that's what that standard deviation talks about. So whether the return is 5% average a year or 30% average a year, you can have different standard deviations based upon how those different returns that are part of that average bounce around. So we'll show another slide that hopefully explains that a little bit better than me stumbling through it. All right, so let's talk about beta. So beta is another risk measure that we see often. So beta can compare either the volatility, so once again, the volatility that we're talking about, of an individual security or a portfolio in relation to an index or benchmark. So instead of, with standard deviation, instead of comparing it to the average return, we're now looking at the return of something else, an index, which in a way is the average return of that specific benchmark, right? That's what an index is. So what beta measures is, well, let's use an example. So whatever that index is that you're comparing it to, if the security or the portfolio is bouncing around the same amount as that index, the beta is 1. So that would be something that you could say that that portfolio or that security is equally as volatile as the index. If you have a beta that is above 1, that means that security or that portfolio is more volatile than the index. So what does that mean? If you have a beta of 1.2, you would expect it to be 20% more volatile, right? So 1.2 compared to 1. So in real life, what does that mean? Well, it means that if the index goes up 10%, you would expect that security or portfolio to go up 12%. The index goes down 10%, you would expect it to go down 12%. So that is beta. So how we can use beta as investors is if we're looking at going out and buying a share or an ETF or a fund, we can look at that overall volatility as measured by beta and think, okay, based on different market conditions, what's going to happen with this share or this fund? And then we also get this R-squared statistic. So once again, it's kind of a derivation on beta, but we're looking at something in relation to a benchmark again. So all of these, of course, are measuring the same thing, volatility. And we'll get into why volatility may or may not matter as an investor. But anyway, that's what you're going to see in terms of risk. All right. Another really important thing to say here is that as investors, we exchange risk for return. So it's the interesting thing about the way the industry measures risk is that the more volatility, so an asset class with more volatility, like shares versus bonds, you get rewarded for that more volatility with higher expected returns. So what we're doing as investors is we are exchanging risk for returns, meaning that the more risk we take on, as long as we're doing it appropriately, we should be compensated for that with higher returns. Now, if you think about what this actually means, it means I may not know my returns in the next year, right? There's a greater risk that returns could be negative in the next year, but over the long term, my average return should be a lot higher. And if you get in that mindset of thinking about what you're exchanging, kind of start thinking about how this works. Okay, so that means if I'm over a very long term, I should be less concerned about this volatility because I know that I'm going to get a higher average return. Now, there are certain times in your life where you could be very worried about volatility, but we'll get into that. Okay, so we've got a couple different examples here. Probably put them in the wrong order, but let's talk a little bit about standard deviation. So these are two different stocks, so share A, share B. Over a 10-year period, these are the different returns they got. Both average out to 10%. So over this 10-year holding period, you're getting the same average return, 10%. Now, as you probably notice, if you look at share A versus share B, is that there's some differences, right? So over at B, most of the returns are kind of around 10%, right? They're all positive, number one. They're all sort of bouncing around, couple percentage, around 10%. We go over to share A, we see they're bouncing all over the place. There was a 50% return one year, and then we have negative returns. So in this example, both of these shares have the same average return, but very different standard deviations. All right. So remember, the higher the standard deviation is, the more volatility you have in that share or portfolio or anything else. And for those that are very interested in stats and math and everything else, basically what the standard deviation figure shows you, that if you have a normal distribution, and don't worry if this goes a little bit over your head, but if you have a normal distribution, what that means is that one standard deviation is 68%. So 68% of the time, the return should fall within one standard deviation. So you see in this portfolio, with a 10% return and a standard deviation of 20.68, you can get huge swings. And then 95% of the time, it should come in within 2 standard deviations of that return. So once again, you can see that there are wild swings. Okay, one more thing to talk about in terms of beta, standard deviation, R squared, all this other stuff. Remember, this is all historic. So like everything else in investing, we have data that is historic. We have a future that's unknowable where things change. So just remember this. None of this stuff is a formula. I feel like sometimes people get very caught up in this that like, yes, beta, for example. Beta is an example where, yeah, there is a formula. Sorry, there's this weird reflection. Okay, hopefully that solved that. So beta, yeah, people get caught up in the formula. Okay, why is this thing hit at a beta of 1.2? Why did it not go up more than the market? Well, because it's historic, right? And things change. And those relationships between individual securities, and in beta's case, the overall market, those relationships are going to change over time. So just remember, these are all estimates. The other thing to illustrate right over here is I just wanted to show you an example. So I went back, I took 3 ETFs. So we got Vanguard Aussie Government Bond ETF, Vanguard Aussie Shares ETF, and this iShares S&P 500 ETF. And I went back and I looked at the 5-year average return. So this is an annualized return. And then I looked at the standard deviation. So this is where the big example, I just wanted to use an Aussie and an international. So that's the US S&P 500. But the big thing I wanted to show is, yeah, if you invest in fixed interest, your standard deviation is a lot lower, but so are your returns. So it's just an example of how we need to take on risk as investors, risk as measured by volatility, which is how the industry talks about it, in order to get those returns. Okay, but let's put this in more of a real world example. I think we're there. Oh no, we're not there yet. We're almost there. Okay. When we start applying risk to portfolios, there are different approaches we can take. We can look at risk tolerance, or we can look at risk capacity. And this is really important because it should frame how you think about risk and what's actually important to you. All right, so the traditional way that the financial services industry has looked at this is risk tolerance. And there's a reason for this, which we'll get into. But basically what risk tolerance says is we know that investors make very poor decisions, and that what drives a lot of those poor decisions is volatility. So both volatility on the upside, where everyone decides that there's less risk and they're going to put all their money in the stock market because it's gone up 5 years in a row, or on the downside, oh my God, it's going down, I'm going to sell everything. So that's what risk tolerance is supposed to measure. And the theory behind this is that if I want to prevent you from making a stupid decision, I'm going to figure out how much risk you can tolerate and get a portfolio that is constructed to make sure that you are not going to be faced with the type of risk, volatility, that's going to make you do something dumb. We'll get into why there's all sorts of problems with that in a second. The other way to look at risk is capacity. So, and if I haven't clued you into it, this is the one I like. Risk capacity looks at how much risk do you need to take on in order to accomplish your goal, right? So seems logical that this is the best approach, and that, you know, people that live their lives this way probably end up a lot better. But anyway, let's talk about the problems with risk tolerance. But we're gonna talk about those problems by introducing our celebrity guests for the day. All right, so we've got 2 people. We're going to go through their life, Christy and Val. All right, and we're going to talk about their different approaches and their different approaches to risk and how that's going to inform the outcome. So here they are, both young, looking good, in the 80s, thinking about investing, want to take some different approaches. Let's start over here with Val. All right, so what is Val doing? So Val, very simply, wants to maximize his wealth, which everybody does. And oh no, we moved into middle age. So Val wants to, maximize his wealth, but he's nervous about the risk that he sees, which is volatility. So he goes and he takes a risk tolerance questionnaire. So when we talk about risk tolerance and the way that the industry measures that, or the way that the industry approaches it, once again, to try to find a portfolio that fits within your risk tolerance so you don't do anything dumb, maybe a nice noble goal, just doesn't work. So what does a risk tolerance questionnaire ask you? Well, the really, really lazy ones only have a couple questions. Then there's some better ones in the way that they structure it. But basically what a risk tolerance questionnaire does is, number one, it'll ask you some questions about you. Are you married? How old are you? Like, how far away is your goal? So they're basically trying to equate demographic stuff about you, about how much risk you should take. And then they're going to ask you what you would do under certain scenarios. So they'll say to you, hey, if the market fell 20%, what would you do? And, there's a bunch of different boxes. I would do nothing. I would invest more because it's cheaper. I would sell everything and hide under my bed. All those different options. So they ask you all these different options. And then by the way that you answer those questions, it will determine your risk tolerance and put you and recommend a certain portfolio for you, an asset allocation in that portfolio. So if you do not have a high risk tolerance and you're very worried about volatility, then they're going to put you in a quote unquote safe portfolio, which means more defensive assets like bonds and less volatile assets like stocks. Now, of course, because you guys attend this thing, you know that what are you trading off by going into that quote unquote safer portfolio? You are trading off future returns. So in this case, young Val, who doesn't understand this stuff, he takes this risk tolerance questionnaire. Turns out he's pretty worried about risk. And he's going to go into a balanced portfolio with 60% of his assets allocated to growth. And he kind of figures, okay, well, I'm young. As I get older and I get more comfortable, maybe I'll want to take on more risk, which I guess is nice. He doesn't know how he's supposed to track if he's going to achieve any of his goals, and he hasn't really thought about his goals, but that's okay, right? Because he took this risk tolerance questionnaire and he's going to be put in a portfolio that matters to him. All right, so why is this not going to work? Not to ruin the surprise. Well, risk tolerance questionnaires, because they don't look at risk capacity, there's a problem. Your goals are never even aligned to what you're trying to do. The other thing is that we as humans are very inconsistent in our desire to take risk. And we unfortunately are inconsistent at the wrong times. So when do we want to take on more risk? We want to take more risk on when the market's doing very well. So this is why everyone piles in at the top of the market. So, and this makes sense, right? Just from pattern recognition, we sit there and we say, okay, the market's gone up and it's gone up and it's gone up and it's gone up for a number of years. The risk is lower for it to go down. Now, we know that's not true, right? Mathematically, we know that's not true. That if you are getting above average returns for 5 years in a row, chances are that next year, or not chances are, we have a higher percent chance of below average returns, because that's how we get the average. The only way we can get down to the average is if we have below market returns to balance out all these high above market returns. But as humans, we do the opposite, right? So we think things are safer when they've been performing really, really well. But the exact opposite is actually true mathematically, right? So hopefully we should know that. And conversely, on the downside, when the market has fallen a lot, multiple years in a row, our risk tolerance actually shrinks. We see the market as more risky. But in fact, once again, it is less risky, because mathematically over the long term, to get back up to that average, we have to have an above average year. Anyway, that's the problem with risk tolerance questionnaires. Also, even though our risk assessment shifts over time, we also can't accurately project what we would do during these volatile times in the market, which makes it basically useless. The whole point of doing this is to protect us from dumb decisions, but we don't know how to actually account for our behaviors under stress. So that's another problem. There's all sorts of problems. Then we got Christy over here. Christy is defining her risk in investing as not hitting her goals. So the way that she's done this, and of course if people have tuned into these before, is number one, she's thought about her goals. So she's trying to retire. How much money is she going to need for retirement? When does she want to do it? She's looked at her financial situation. She's figured out how much she can save, and she's calculated her required rate of return. Now, what that is, of course, is just the average return that you need to achieve over a long time period. In this case, she's got 30 years to retire, but any longer time period, that's just the average return you need to get. So she knows, because this is the average return she needs to get, some years she's going to do better than the average, and some years she's going to do less. But as long as her average works out to what she needs, she's actually going to hit her goal. So what Christy has realized, and that Val has not, she's realized that in order to hit her goals, she needs to take on more risk, right? So she's looking at her risk capacity. So whether she's nervous about the market going up or down, I guess nobody's nervous about it going up, but if she's nervous about the market going down, she realizes that doesn't matter, because if I don't take on risk, I won't get returns over the long run, and I won't achieve my goal. So just the act of doing this and her thinking through how this actually works is going to help her achieve her goals. So she's also aware of the different levers that she can adjust to try to hit those goals, right? So it's not just that return she's making. It's also how much she saves. It is when her retirement actually is. So there are other things that she can do. She can adjust when she's going to retire. She can adjust how much she saves. So she understands that. And she understands by going through this exercise and by thinking about this is that while she's younger and has a smaller portfolio balance, what is really important to her is hitting her savings goals, right? Returns matter less to her because she has such a long time to go until retirement. What does matter and what she cannot get back is time. So she knows she needs time in risky assets to earn the returns that correspond with them. And she needs time to invest and then compound and hit her goals. So she now sees volatility as an opportunity and not a risk. And why is it an opportunity? It's an opportunity because lower security prices mean that you have higher expected future returns and that you can buy more, right? So at the end of the day, it's just stocks going on sale if the market goes down. Now, she doesn't have to market time anything. I'm not saying that she needs to build up cash and then invest it all when the market's at the bottom, because that's very difficult. But at least she knows that if the market's falling and she's continuing to dollar cost average into her account, so continuing to put steady savings invested into her account, she knows times where maybe it's stressful for her to see her portfolio balance go down. She knows that she's actually there are opportunities there and that the money she's investing will go further in the future. All right, so they move on. All right. I mean, she's aging a little bit better than him. He's, grown his hair out a little bit, but that happens. So now they're actually getting to this point where they're transitioning into retirement. This, by the way, should not say 5 years or more. That should say 30 years. I'm just an idiot. So now they're within 5 years of retirement. So we'll start with Val again. So all of a sudden, now that he's within 5 years of retirement, he's never bothered to figure out how much money he needs. Right? Because he took this risk tolerance questionnaire, they put him in a portfolio, so stuff will just work out. So he's never bothered to figure out what he needs for retirement, and now he's starting to worry. So he's a little bit worried he's not going to hit this lifestyle. So what does he do? He finally starts reading a couple things, and he goes, okay, well, I guess I need to save more money. So he's trying desperately to save more money, and then he's saying, okay, well, I really need to, invest in shares because that's the way that I'm going to make up for lost time. So, okay, that's what he's doing. He's still very worried about volatility because that's still how he thinks about risk. And so he thinks, okay, I'll just watch my portfolio very, very carefully because if it starts going down, I can sell and that will reduce the risk in my portfolio, move more into cash. Once again, he is not thinking about his actual retirement. We'll get into sequencing risk in a second. Okay, Christy's in better shape, right? So she's more confident that she's going to hit her goals. Now, when she went back as young Christy and defined her retirement, of course, things have changed, right? So she's changed her expectations for retirement. Her salaries fluctuated over time. Maybe she had a bad marriage to a rock star named Billy Joel. Anything could have happened in her life. But the point is that you don't have to, just because you establish a goal, it doesn't mean you are locked into that goal forever and there's no getting out. So she understands that she can adjust her goal. She understands what the ramifications are of adjusting goals in terms of the fact that she needs to save more, the fact that she needs to, the fact that she could change around the time frame of when she wants to achieve that goal of retirement. But she's still confident she's going to make it because she is looking at her portfolio and she's tracking it against her goals. Now, she understands, unlike Val, because she understands math, she understands that the last 5 years, and every year as you get towards your goals, your savings matter less and your portfolio returns matter more. Because when Christy was saving $10,000 a year and she had a $50,000 portfolio, every year, no matter what that portfolio is doing, she's putting in 20%. Right? So she's saving 20% on top of what she already has. So that's why her savings were so important. And that's why time was so important for her. But now she's done really well. She's still saving $10,000 a year, but her portfolio is worth $1 million. So now she realizes that $10,000 is very little compared to that overall portfolio size because she understands math. So now she's sitting there saying, okay, the focus right now is on portfolio. And they both have started to, well, Christy's figured this out. Val's just faced with it, doesn't realize it, is their big issue right now is sequencing risk. So what sequencing risk is, and we'll get into it in the next couple of slides, is that's something that you really need to worry about in transition to retirement. It's the order of returns versus the average return, right? So over the long term, we should be very, very concerned with the average return, which is why during market downturns, we shouldn't sell because we're going to miss out on the recovery. All right, so what's sequencing risk? All sequencing risk is as it says, is how does the impact of the sequencing of returns impact how much money you have? So we're going to take a very simple example. All right, so we've got $10,000 going into the US market, and we are going to start over this 20-year period. And the period we looked at was 2000 to 2020. So put in $10,000 a year, and here we go. So pretty good, right? So we've saved $10,000 a year. We now have, at age 45 here, so started at 25 years old, at age 45, our portfolios were $745,000. So pretty good outcome. And these are actual returns, right? So these are actual US, it's the Morningstar US Market Index. So think of it close to the S&P 500. These are actual returns, so pretty good, right? Then we switch those returns in order. So basically what that means is we took the 2020 return, the actual return, and we put that back in 2019 to 2001, et cetera, right? We literally just reversed the order of the returns. Now, obviously, since we know math, the average return achieved over both these scenarios is exactly the same. Literally exactly the same. Now, what's our portfolio worth? $345,000. Now, for those that understand kind of market history and what's happened, a lot of bad stuff happened here. A lot of bad stuff happened in the year 2000, which is now being pushed out here. So that was the dot-com bust, right, that happened. We've changed around and made later in life the GFC fall, right? So pretty stark how these, just the sequence of returns can have a huge impact on how much money you have. So neither one of these people in either one of these scenarios was obviously doing anything but investing in an index fund. So nobody was a better investor or worse investor. They're all paying the same fees. But yeah, very, very different outcomes. Now, when does this really matter? In this scenario, we're just getting to age 45. But when does this really matter? This really matters right before you retire. And the reason, of course, is as soon as you hit retirement, you're going to start taking money out of your portfolio instead of putting it in. which means that if you have low returns right before you retire or as you retire, it's a problem because you are selling your portfolio when the market is low. All right. So that's sequencing risk. So how are they both dealing with sequencing risk? Go back to our friends, Christy and Val. So Christy is dealing with sequencing risk. She realizes that the problem, once again, and hitting retirement is not like you don't hit retirement and then it's over. You don't have to invest anymore. Hitting retirement is a big milestone in your life. But from an investing standpoint, it doesn't really matter because you have to continue to invest for a long time because most people live a very long time after retirement. So she understands this and she understands, okay, sequencing risk could impact the ability to not hit her goals. But the only reason sequencing risk does impact her ability to basically her concern that she's going to run out of money is because she'd have to sell when the market was low if the market falls. So she thinks, okay, I've got some cash. I've got income being generated from my portfolio. Maybe this is an opportunity where I can build up cash, especially because I know this $10,000, if we're using that example, this $10,000 I'm putting in every year, I know that it's not going to have that big of an impact on my returns when I hit retirement because there's not much time left. Now, could obviously over the long run, but still, she realizes that she can build up some cash. She won't be impacted by sequencing risk because she can simply not sell securities if the markets are doing really poorly because she'll have this cash reserve. So this is basically the bucket portfolio that she's using. All right, let's move into retirement. All right, here we go. So Val, as you can see, has been very stressed by his financial situation. So he has aged a little more than Christy, who, let's be serious, has not aged at all somehow. But anyway, let's talk about what they're doing now and the risks they're facing now. Okay, we'll start with Val again. So Val, once again, who likes to take shortcuts with investing, read a couple things. So he read about the 4% rule. And he read about this rule that his asset allocation should be 1 minus his age. Now, both of these are kind of old concepts, but Val doesn't care. He read them. They make sense. It's a rule of thumb. So great. That's what Val's going to do. So he says you can't run out of money if you take 4% out of your portfolio. And 1 minus his age should be the amount that he has in equities. So that's easy, right? He turns 70. He's got 30% in equities. 80, 20%. Easy, right? So there's a little bit of a rule. So rules of thumb make things very, very easy. Chrissy, on the other hand, I can't speak, understands what she's actually worried about here. She knows that she's faced with 3 risks in retirement. So she is faced with inflation risk, right? So she's not making any more money. You would hope that if inflation goes up and you're younger, that hopefully your salary would go up. Also that inflation, can, if you're still invested in equities, you can still do okay in an inflationary environment, right? Because those price increases, you're owning companies, those price increases could be passed on by the companies. Now, there's a lot of reasons why shares don't do well in inflationary environments, but she realizes, but they do better in bonds, no matter what. So she realized she's faced with inflation. She's faced with market risk. So obviously there's always market risk involved, but she understands that, okay, market risk in this case is something I need to take on because I'm going to live for a long time. I mean, look at her. She looks like she's like 25. So she could live forever for all we know. But she also realizes that her living forever, the problem is longevity risk, that she will outlive her money. So Val is just concerned with longevity risk because frankly, he could die any minute. And so he just doesn't want to run out of money, right? So that's what he's worried about every year. All right, so what does Christy do? Well, realizing that she has these 3 different risks, realizing that she has potentially 30 years of retirement. So somebody born in 1977, they're thinking they're going to live to 94 years, right? So That's 30 years of retirement, right? If she retires at 65. So what is she doing? She's saying, okay, because I have such a long time to invest, I need to keep money in equities. It's really important. So how can she stop volatility risk? So this market risk, how can she try to alleviate some of that? Well, a couple of things that we'll talk about. So she could use a bucket approach to her portfolio withdrawals. So once again, that is putting your assets into different buckets based on volatility. Cash, which has no volatility, has a lot of inflation risk, but no volatility. Keep enough in cash to fund a certain number of years of withdrawals. She can use that to allow her to ride out any market volatility so that she does not have to sell her shares when the market's doing really poorly. She can sort of time her sales better by how the market's doing by keeping cash. She could use an annuity, for example. So she's worried about longevity risk. What's an annuity? Annuity is, and there's all different types of annuities, but an annuity is a contract that guarantees you'll get a certain amount of income for, depending upon what's in the contract, a lot of them until you die. So that protects her from longevity risk because she's thinking about what the actual risk is. And then she also looks at her own just personal finances. And there are ways, of course, to, as we hear a lot with super conversations, there are ways to, of course, set yourself up, like not having a mortgage in retirement, where you can adjust the expenses you're faced with and sort of realize that obviously if you're adjusting those expenses, even if you're selling down assets to do that, or not putting more money into the market, for example, to do that, if you can get rid of your mortgage, well, then your expense base is a lot lower. So those are the different things Christy is doing. And Val, he's just in trouble. Thanks for joining. I'll be back on Thursday talking about, I don't remember, something else. And then Thursday night, we'll be talking about constructing a portfolio. So yeah, tune into that. Thank you guys very much.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.